check markets and what is happening with our investments with the time for the word on Wall Street. Top investors watching your money. Joining me right now is LPL Financial Chief Investment Officer John Lynch, Bulltech Capital Markets Chief Strategist Kathryn Rooney Vera, and Michael Lee Strategy Founder Michael Lee. Great to see everybody this Monday morning. Thank you so much for being here. Kathryn, kicking things off with you ahead of this Federal Reserve two-day meeting beginning tomorrow. What are you expecting to hear? A lot of expectation that the Federal Reserve will raise rates at least 4 times. Goldman Sachs is now saying inflation will cause even more than that. And I spoke with Bank of America CEO Brian Moynihan on Friday about his expectations. Here's the CEO of Bank of America.
So the market expects, 4 Fed increases this year. We agree with that. Our research team, which is terrific, says 4 Fed increases. There's some expectation it may move faster because the inflation numbers are really large. But what that will do is start to bring the growth rate in the underlying economy back to normal. So if you think 6% for last year, 4% for this year, and 2% or so for the U.S. economy for next year, that's normalizing the activity, which is important to bring, to stop the potential speculative aspects and things that go on when money's too loose.
Kathryn, we'll see how many they are, but are markets ready for this?
Markets are clearly ready for 4. More than that would induce probably more of a sell-off because the market has not discounted that. So the biggest risk this year is Fed policy risk. That's something we've been saying at Bulltech for some time. Inflation is inordinately high, and the Fed has let it run far too long, even explicitly saying that would be more, would be fine with running it hot for a little bit. It's done that, and now inflation expectations are more ingrained. We have chip shortages sending, car prices up 40% year over year. That doesn't seem to be abating. We have a wage price spiral, which is another thing, Maria, that the Fed has gotten wrong. This is certainly not temporary inflation. We have wage price spiral, and we are at full employment. So this is kind of too long in the offing. The Fed is going to signal a March rate hike and a roll-off of the tapering and possibly some sales by the end of the year. My biggest concern, Maria, is Federal Reserve policy risk. They painted themselves into a corner. The federal government has exacerbated the problem by this massive injection of spending that's unfinanced, so the Fed has been monetizing that. But if the Fed goes more than 4, then you could get a scenario called stagflation, which is something that Brian is talking from a positive light, the deceleration, but not quite stagflation, which is defined as economic growth that goes below potential growth. Potential growth in the U.S. is 2.5%. So we don't want to see the Fed induce the next recession, which is historically, if you look at economic cycles and changes therein, peaks to troughs and troughs in expansion. It's kind of an economic cycle. It's inevitable. But usually the Fed, or not usually, but many times in the past, the Fed has hiked rates, causing the next recession. I doubt the Fed goes more than 4. I think that would be probably too aggressive. They'll do that over the course of a few years, but not in one, and not if the market hasn't given them the green light to do so. But the biggest risk, I think, right now is stagflation, which is persistently high inflation, regardless of what the Fed does, and a very steep slowdown in economic growth, potentially below potential. At this point, I agree with Brian. I think we probably get a lower economic growth. I don't see 4%. I see 3% after last year's astronomical, 5.5%, 6%. But the Fed has to tread a very fine line, and it's painted itself in a corner.
Yeah, and I know that you're watching growth so far. You've been optimistic on growth, but we'll leave it there. John Lynch, Kathryn Rooney Vera, great to see you both. Thanks so much for joining us this morning.